Welcome to the APP Group's Connector series. In each short episode, we aim to bring together people, stories, ideas, and solutions, showcasing how the APP Group connects with our clients, partners, and the communities in which we operate. As one of Australia's most respected property and infrastructure consultancies, we aspire to be a trusted partner that unites stakeholders through best practice initiatives, services, and advice that results in value creation outcomes. Today, I'm joined on the couch by Richard, the APP Group's General Manager, Property Advisory and Economics. Richard, thanks for joining us.
Thanks, Ben.
With the year now well underway, can you tell us, with your economist hat on, a little bit around what the outlook looks like?
Look, it's been an amazing 3 years to look at since the pandemic started back in early 2020. We had this sudden crunch in consumer confidence, and we're actually at that level today. Consumer confidence is almost as low as it was at the start of the pandemic after a very strong rebound in confidence through 2022. That's going to play out in retail turnover declining, and we're already seeing unemployment start to tick up. It's been a tough period for the Reserve Bank to manage this. They've got imported inflation that they really can't influence in oil and gas prices. We've also had periods of drought that have influenced production in Australia. And on the flip side, businesses in Australia have been trying to recover the lost income during that 2022 and 21 period. So quite understandably, we've seen prices shooting up. Any retail turnover for a lot of businesses now is significantly more expensive than what it was. But I think over the coming sort of 12 months, we're going to see a moderation in those price increases. The price levels won't fall, but the rate of growth should start to stabilise. And that's where the Reserve Bank hopefully will start to take the foot off the accelerator in increasing interest rates.
Well, we're looking forward to that moment, most of us. If we turn our attention now to infrastructure, what are some of the risks and opportunities of where the outlook for infrastructure is around the country?
We have record spend in infrastructure by Commonwealth and state governments, which has led to a significant increase in debt. And that is also driving up interest rates in the broader economy as well, as state governments and Commonwealth governments borrow to fund infrastructure. We've got a labour force supply crunch happening at the same time, and the infrastructure and engineering sector drawing labour force from our traditional sectors. We've also got a demographic crunch, if you like. So your 30 to 50-year-olds, that portion of the labour force hasn't grown significantly as a supply of population. So it's going to take time for immigration and population growth to recover and provide that skilled workforce we need. So this medium-term constraint we have in skilled labour, particularly in the skills that drive our infrastructure delivery, engineers, project managers, that's not an overnight fix. It's going to take time for that to play out. And that skilling up of the economy is going to be absolutely critical to get it right.
Well, thanks for sharing those insights. And finally, what if we turn our attention now to the property outlook? What's your view?
I think there's really three drivers. We're going to see the CBDs continue to reinvent themselves as centres for education and centres for entertainment. And we're already seeing that happening today. The period of a 5-day-a-week return to office is not going to happen. That's going to evolve and play out over time, but that role of the CBD has changed forever. And I think that's a good thing. Secondly, in terms of housing affordability though, we've seen this enormous decline in the ability of a median income family to purchase property. And we're seeing that in Melbourne, Sydney, Brisbane and Perth. So the household budget has declined from $800,000 to $900,000 for that median income family down to around $480,000, $500,000. That's not going to change quickly. Costs of living won't change rapidly and interest rates may come back a little bit, but that budget's going to persist for some time. So we will see apartments getting more popular and we will see demand for apartment product priced at that 500K range starting to increase significantly. Thirdly, we're going to see governments having to subsidise housing a lot more. There's going to be greater proportions of the population in a tight rental market. Rental vacancy rates are going to stay very low, and we're going to see this pressure at the margin for a lot of households and a lot of groups seeking assistance from government.
Thanks very much, Richard, for joining us and sharing those insights. Look out for our next episode appearing soon. For now, take care and goodbye.